Welcome to today's Explainer. We're going to completely demystify the incredible and honestly kind of magical world of banking. Have you ever wondered how money actually moves around your city? Or how those massive bridges and big new schools actually get funded? Well, you're in exactly the right place. We're going to break down the whole financial infrastructure that runs our world. And I promise, by the time we're done here, you're going to look at your old piggy bank in a totally new light. Okay, so let's just dive right into this by asking a really simple question. What actually happens to your cash when it leaves your hands and goes into a bank? I mean, think about it. If you take your hard-earned savings and just hide them in a cupboard at home, sure, they might be safe from your snooping siblings, but it just sits there. It doesn't grow, it doesn't do anything useful at all. But when you hand that exact same money over to a bank, oh, it embarks on a pretty wild adventure. Section 1. Meet your financial matchmaker. To really understand banking, we've got to stop thinking about a bank as just some giant cold vault holding piles of cash. Instead, start thinking about it more like a super helpful neighborhood matchmaker. Let's look at a real-world example to see how this matchmaking actually works. On one side of town, we have Navdeep. Now, Navdeep is a hardworking guy, and he manages to save 3,000 rupees from his salary every single month. He knows hiding all that cash in his cupboard isn't safe, right? So he's looking for a secure place to store his extra money. Now, on the complete opposite side of town, we have Rima. Rima runs this really fantastic business making bamboo products, but she desperately needs some extra money to buy materials so she can expand her operations. Her friends and family just couldn't lend her quite enough, so she needs a loan. And boom, this is where the magic happens. The bank swoops in as the ultimate financial matchmaker. They bridge the gap between people who have extra money and people who really need money. The bank takes Navdeep's 3,000 rupees, which in bank terms we call a deposit, and they turn right around and provide that exact money to Rima as a much-needed loan. So think about that. Navdeep's money is now actively working to help Rima build her dream business. Section 2. Inside the bank vault. Now, because banks are dealing with literally millions of people just like Navdeep and Rima, they obviously can't just throw all the cash into one big messy pile. To keep things organized, they use different boxes, which they call accounts. If you're just a regular person trying to save some of your allowance or your salary, you'd use a savings account. And get this account actually pays you a little bit of extra money just for keeping your cash there. Now, if you're a business owner making dozens of transactions a day, you'd use a current account that lets you move money constantly without any limits. And finally, if you have a chunk of money that you know you won't need for a few years, say 3 to 5 years, you can use a fixed deposit. You basically lock the money away for a set time, and in return, the bank pays you the highest amount of extra money. Of course, with thousands of people putting money in and taking money out every single day, the bank has to have a way to track all these moving pieces. To do this, they give you a passbook. You can think of a passbook as your own personal financial diary. It keeps a meticulous, line-by-line record of every single move your money ever makes. So the absolutely crucial point here is knowing how to actually read the language of this diary. When you look at a bank statement or a passbook, you are going to see two very important words. A debit means money is leaving your account, like when you buy a movie ticket. A credit, on the other hand, means money is coming in, like when you get your salary or you deposit a birthday check. So just remember, debit means out, credit means in. Simple as that. Section 3. The magic of compounding. Remember earlier when I mentioned that savings accounts pay you extra money just for keeping your cash there? Well, that extra money is called interest, and it leads to a truly mind-blowing mathematical concept. It's an actual real-life magic trick called compounding. Imagine you get a 1,000 rupee gift for your birthday. You take it straight to the bank, and they promise to pay you a 6% interest rate every year. Okay, so at the end of year 1, the bank adds 60 rupees to your account. You now have 1,060 rupees. Pretty cool. But here's where the magic really kicks in. In year 2, you aren't just earning 6% on your original 1,000 rupees. Nope, you're earning 6% on the new total of 1,060 rupees. So, this time, you earn 63 rupees and 60 paise. Your total becomes 1,123 rupees and 60 paise. You are literally earning interest on top of your interest. That's compounding. And to really picture this, there's a brilliant old story about the king of Umbalapuzha. He was challenged to a game of chess by a visiting sage. Before they played, the sage said, "Look, if I win, I just want 1 grain of rice on the first square of the chessboard, 2 on the second, 4 on the third, just doubling every time for all 64 squares." Well, the king literally laughed at such a tiny reward and agreed immediately. But then the king lost. when the king's courtiers started placing the rice on the board, they very quickly realized they had a massive problem. By the 8th square, it was 128 grains. By the 16th, it was over 32,000. And by the 32nd square alone, it required over 210 crore grains of rice. The king was absolutely shocked. And honestly, the story perfectly proves the explosive exponential power of compounding over time. Just like those grains of rice, your money can grow into massive sums if you just leave it alone to compound. Section 4. How do banks profit? But wait, this brings up a massive question, doesn't it? If the bank is constantly paying you this magical compounding interest just for storing your money, how on earth do they make any money to pay for their massive buildings, their computers, and all their employees? Well, let's look at the math and uncover the bank's own little magic trick. Let's say Anand deposits 200 rupees into his savings account. The bank tells Anand, hey, we'll pay you 2% interest. So the bank owes Anand 4 rupees. But remember, the bank is a matchmaker. They take Anand's 200 rupees and they lend it to Shreya, who really needs a loan. But they charge Shreya a 5% interest rate. So when Shreya pays back her loan, she has to pay the bank an extra 10 rupees in interest. Do you see what just happened there? The bank unmasks its trick by simply keeping the difference. They collected 10 rupees from Shreya, and they gave 4 rupees to Anand. 10 minus 4 equals a 6 rupee profit for the bank. It's that simple. They make their money by charging a higher interest rate to borrowers than the interest rate they pay out to savers. And that tidy little 6 rupee profit, that's exactly what keeps the bank's lights on. Section 5. Banking for everyone. So, this entire system of deposits, loans, and interests forms the total backbone of a nation's financial infrastructure. But here's the catch. For a long time, not everyone was allowed inside the vault. Before 2014, only about 15 crore Indians had bank accounts. Most people relied entirely on physical cash, which, let's be honest, is risky and really hard to save. But then, a massive government program called the Pradhan Mantri Jan Dhan Yojana was launched. Because people could finally open accounts without needing to maintain a minimum balance, that number just exploded to over 50 crore active accounts today. Think about what that means. Now, farmers can easily get loans, workers get their wages transferred instantly, and students receive scholarships directly into their accounts. It completely cut out the middlemen. We have covered a lot today. Everything from the matchmaking magic of banks to the completely explosive power of compounding. But the world of money is moving faster than ever, straight into our smartphones. So, as you walk away from this explainer, I want you to take some action. Talk to your family. Ask them exactly how they use UPI and digital transactions in their daily lives. But more importantly, ask them what steps they take to avoid digital scams and those fake calls asking for bank details. Because as the magic of finance becomes more digital, the responsibility to protect it totally falls on us. So I leave you with this thought. If physical money is slowly disappearing into digital code, what will a bank even look like in 50 years? Think about it.